Oscar Health just reported earnings, and you want to know the good, the bad, and the ugly. You also want to know if you should be buying more shares here or selling and cutting your losses. In this video, we're going to get into my high five snapshot later, where I actually give you my bear thesis, my full on bear thesis, and show you that today, Oscar's still actually a buy. We're going to go through their quarter two results, and we're going to look a little bit at the charts and some visual stocks, some charts on that as well. So let's get into it, guys. Also, if you like this type of content and you're new here, do me a favor. I'm a small guy. Drop me a like, leave me a subscribe. I'm looking to grow an amazing community with you all, and I look forward to growing this community for the years to come. Let's get into it. So, up here, we can clearly see that they were expected to come in with almost 81 cents of EPS, negative 81 cents of EPS, and they came in and they missed with 89 cents of EPS, and they also missed on revenue, 2.92 billion expected, and they came in with 2.86 billion. They double missed on revenue and EPS, but they already they gave preliminary guidance on this quarter, and they already told us that this year is going to be a net income loser due to higher medical loss ratios. But let's look at the instant reactions here. Instant reactions were an 8.41% move to the downside to where we bottomed out about $12.84. And from there, we ripped all the way up to went from red to green on the day and actually closed the day up 3.76%. Now, why did this happen? Well, if we get into the report here, you can see that I actually gave the grade of C plus, a C plus for Oscar's earnings. And just I'm going to briefly go through all this and highlight some key components of the earnings report. I'm not going to bore you all to death and go through all this. If you want to read all this, you can pause the video or you can go to IR Oscar. So we believe the individual market has long-term upside and is the future of healthcare, said Mark Bertolini, CEO of Oscar Health. Oscar is well positioned to manage through the market reset in 2025. We believe the market will stabilize next year and expect return to profitability in 2026. That is huge. We're building the individual market into a healthcare marketplace for more consumers and businesses and continue to position the company for long-term growth. So just some tidbits here. They went from 2.19 billion in revenue in 2024, now up to 2.863 billion in revenue. The MLR ratio, this is not good, that jumped from 79% all the way up to 91.1%. The medical loss ratio is higher across the board in the healthcare sector. So this is not an Oscar issue. This is a sector issue. And we've seen it with United Health Group, Centene, and others. So it's going to be, they guided for 86 to 87% for the full fiscal, or for this full year of MLR ratio, medical loss ratio. So SG&A expenses were down 19.6 in 2024, down to 18.7%. The SG&A expense ratio continues to come down, meaning they're continuing to be very lean and mean on the bottom line, very lean and mean as a business, and meaning that they are continuing to bring down costs while revenues are exploding, 31% revenue growth year over year. And they're expected a 30 to 32% full revenue growth year over year by end of year 2025. Obviously, we know the earnings loss, 67.812 million down to negative 230, 56 positive down to negative 228, 104 positive down to 199 negative on adjusted EBITDA. Here's a big thing. 2024, they had 1.522 million. I wish billion. 1.552 million individual and small group offerings, membership by offerings. Now they're at 2.017 million. And they went in the Cigna plus Oscar, they went from 58,000 down to about 10,000, which I actually think is a good thing. We want this area to be growing and not this partnership, really, in my opinion. I want to see, because this is a co-branded partnership with Cigna, I want to see Oscar coming out on top and continue to grow their brand, not a co-brand. So total members went from 1.58 million to 2.027 million. Very, very good there. Some highlights I had in here. The medical loss ratio is 91.1% for the second quarter of 2025 compared to 79% for the second quarter of 2024. The increase was primarily driven by increase in average market morbidity that resulted in an increase in the risk adjusted transfer accrual. The SG&A expense ratio was 18.7%, like we talked about for this quarter, down from 19.6% this time last year in 2024. The decrease was primarily due to lower exchange fee rates and greater fixed cost leverage, what they're doing in the business, partially offset by an impact of the higher risk adjustment as a percentage of premium. Net loss, we already talked about this. We know that they're going to be losing this year, but I believe next year, and they even said on the earnings call, they expect to get back to profitability in 2026, which means this is just one of those down years, and then they're going to get back to profitability next year. So the rest of this, like I said, I don't want to bore you guys to death going through this. We can just kind of jump on over into visual stocks now and kind of get a more visual picture of this. So revenues 29% quarter or year over year, right? I said 30%, but it's going to be 30 to 32% for this year. So 29% year over year. Obviously, we know this profit improvements. It's way down, obviously, because they went from positive net income now to negative net income. And again, due to medical loss ratio, they have now a negative PE, obviously, because they're losing net income and they're not a positive business. But again, expect that to get back to normal. And I expect free cash flow to still be crushing it. Basically, for this year, they should be still at a pull out a free cash flow positive year and then get back to 2026, 2027. Also on the call, they said that they reassured this full year guidance. They also reassured the 2027 5% margins and $14 billion in revenue. Now that is huge to reassure it, to say, yeah, we still believe that we're going to get there in 2027. That is huge because that puts a stock at $40+ per share, and they're currently at $14.34. So, yeah, total members. So we had a quarter over quarter deceleration. We went from 2.039467 to 2.02 million. Now, I'm not too worried about this, as if we look back to Q2 in 2024, we were at 1.58 million, and now we jumped all the way up to 2.027 million. So they lost probably about 12,000 members quarter over quarter, but they're continuing to grow in the larger picture. Total premiums earned, a little bit of a drawdown there. This quarter, again, they had less members, less premium. Medical loss ratio, we know it spiked up to 91.1%. Revenues are, again, expected to, they didn't have a quarter over quarter growth, but they did have a massive growth, like we talked about already, 2.2 million to 2.8 million. Net income is, way down here, obviously, but we were steadily getting positive net income, and we'll get back to that in 2026. And then free cash flow was doing really well, but now we didn't have any free cash flow for this quarter. We did have good operating cash flow, though, $1.387 million in operating free cash flow. Shares outstanding slowly ticking up a little bit. Cash to debt to bonds. We have, they actually increased their cash position quite well, in my opinion. $938,000 in bonds, almost $2.6 million in cash, and then only $300,000 in debt. Very, very good. They could pay off all their debt. And honestly, $2.6 million in cash plus the bonds, that's basically, they almost have a little over $3 million in cash and bonds. Their market cap's 3.6 billion. It's crazy. It's crazy. Yes, they have to use some of this to pay out premiums. I understand that, but still having almost as much cash and bonds together, cash and investments to pay off your own market cap is absolutely insane. Paying off premiums or not. Operating expenses have been climbing a little bit over the past few quarters, but again, overall, they're percentage wise based on revenue. That's what you really have to look at based on revenue and percentage wise. They're continuing to bring those down. Let's see, members breakdown. Obviously, we continue to grow the individual and small group. Average revenue per member, that has continuously grown here, as we can see. And if we look at a yearly, guys, we can see that we are continuously growing here, and that's what we want to see. A little bit of a bop down from 2023 to 2024, but you can see that we're going to eclipse that very in these last few quarters. Stock-based compensation, they got that really, really under control here. Ratios, um, revenue estimates. So they're expecting 3.05 million in billion in Q3, and then they're expected 2.97 billion in Q4, and then they have them going Q1 2026, Q2 at 2.775 and 2.717, and that would be they actually have them coming down year over year a little bit on the revenue side of things. And then here they have them getting back to net income or EPS positive on EPS here. So overall, before we get into the high five snapshot here, I just wanted to talk to you guys for a minute. Overall, they gave preliminary guidance. We already knew what was going to be coming from these earnings. We already knew that for this year, they're going to be net income negative, but they assured us that they are going to get back to net income positive. They're taking the right precautions to get back to net income positive, to get back to EPS positive, and to get that free cash flow back to rolling like they were doing in the beginning of this year and last year. They reassured us of that in 2026, and they also reassured us of 5% margins and $14 billion in revenue in 2027. Okay. So that is only 2 short years away that they are going to be getting those lofty targets. And that is a $40 to $50 fair valuation for those targets. And they are currently a $14 stock. So you are almost 3 to 4xing your money if that comes to fruition. Not only the fact is if they grow in ICRA like I expect them to, and if we get an ACA subsidies extension, which I also believe that will be taking place before September. I just believe that Republicans, with 66% of Republicans using ACA subsidies, it's going to really hurt Republicans for midterms if they don't approve an extension for ACA subsidies that is basically watered down with Republicans, not Democrats. And that is going to bring a ton of people to town halls and their governor offices and across red states. That is going to bring them to the doors of Congress, knocking them down and saying, "We are mad. We are mad that you did not extend ACA subsidies. And now all of our health insurance premiums are skyrocketing, Because you have to know about these health insurance companies. They are just going to charge what they need to charge in order to make sure that they still get their cut and you still get your health insurance. That's how it works. We all know how car insurance works. We pay car insurance every single month, every single year, and we might never get in a car accident. But if we ever do, we know that we have the car insurance to call, make a claim, and then get our repairs fixed. Or if we're at fault, get our repairs and the other car's repairs fixed. That is what insurance is. It's giving money every single month to have that protection when things go wrong and the worst happens, that you are covered. They're going to charge to where they get paid because they are a business, and rightfully so. and so they can cover your butt if you go out and get in an accident, or go out and lose a limb, or something bad happens. Okay. So a lot of Republican voters are going to get really mad if premiums spike and they have to pay out the wazoo for health care and health insurance. If they have to do that, they're going to be very mad. They're going to go to Congress. And then guess what? Republicans might not win the midterms and they might lose the Congress or the Senate. And I could tell you, the guy up top, he wants full control. He does not want to lose Congress and Senate. So even if it's for 6 months or a year, ACA subsidies getting extended before September, I do believe some sort of deal will come out of this and ACA subsidies will get extended. And that's all I really have to say about that. What I have to say about the earnings overall, again, a C plus. I love that they have increased and sped up that revenue growth, that top line growth. I understand in this business that they were guiding for medical loss ratios that were lower. And then out of nowhere, across the sector, not just for Oscar, across the sector, we had a large spike in medical loss ratios this quarter that are expected to come down a little bit for the next 2 quarters and giving us an average of 86 to 87% medical loss ratio over this whole 2020 year of 2025. And then, like they said, getting back to profitability by increasing, they said this on the conference call, on the earnings call, by increasing premiums, by increasing um, in different states to basically adjust for these higher medical loss ratios. Again, they're going to do what they have to do because at the end of the day, they're an insurance company. At the end of the day, I don't know too many people that are running out the door to go and cancel their car insurance if it goes up 10, 20, 30, 40, $50 a month. I know it sucks, but at the same time, unless you can go to a different company and get cheaper, or you want to go through that whole process, or you don't want car insurance at all, which it's legal here in the United States to not have car insurance at all. It is what it is. We all need medical insurance because we never know what's going to happen. So overall, EPS, yes, that's disappointing. It's disappointing to see them go from profitability of 10 cents EPS now to a negative year. But again, I trust in Mark Bertolini. I think he's a phenomenal CEO. He was a co-CEO, remember, at Bridgewater next to Ray Dalio. So he knows stocks. He knows how to play the stock game. He knows how to play the Wall Street game. And he was the CEO of Aetna, taking the stock price from like low 40s up to $200+ per share, and just having a phenomenal run with that company over the year, which is a health insurance, which was a health insurance Goliath before they were bought out by CVS. And again, I just believe in Oscar Health's mission here. So super 30% plus revenue growth for 2025. I think they can carry that on into high teens or 20% plus revenue growth for the years to come if they hit the ball out of the park. If not, then I still think they can do between 10 and 20% per year on average, with some years being maybe negative next year if ACA subsidies aren't extended. I can see them having a negative revenue year over year growth, but getting back to profitability and good free cash flow. And that's what really matters. And then knocking out of the ballpark in 2027 after they continue to grow ICRA and everything. So overall, we kind of already knew what was happening here. We kind of already knew about the net income. This was all already priced in. They came out, said 30% revenue growth year over year. We're doing 12 billion revenue this year instead of 11 billion. And then we're going to be net income negative for XYZ reasons. They told us that a couple weeks ago, and the stock came down a little bit, stabled out. And yeah, you weren't really going to get this like shellacking big move to the downside because we already knew what was coming. But anyways, let's get into my high five snapshot. Let's get into that bear case, the bear case of Oscar Health. And again, guys, if you're still here, still enjoying the content, leave me a like, drop me a subscribe. I appreciate you guys. I love you all, and I love this community that we're building. So, bear case. You ready for this? Let's just roll through it. Bear case, right now, free cash flow margin, they're doing 10%. I have them dropping down to 2% for the first 5 years and 5% for the last 5 years of this overall 10-year analysis. I have them getting a 10 terminal fair value of multiple free cash flow. I have them growing 31% this year, which they've already guided for. Then guess what? I have them going to -6% revenue growth next year, and then only 13%, 10, 11, 8, 6, 4, 2% revenue growth rates. Just very low, just garbage revenue growth rates. Terrible. And guess what? Them getting this 13% and based on these revenue growth rates, they would be at $12.7 billion in revenue in 2027 when they're telling us they're going to do 14 billion in revenue. So just take that in mind. That's why this is the bear thesis. This is saying, okay, Mark Bertolini, I don't think you're going to hit that number. I think you're going to only do 12.77 billion in 2027, and then it's going to take an extra year to 2028 for you guys to get to 14 billion, and then growing super low, like low teens, high single digits revenue growth rate. After all that, after beating this thing up, you still have a $27 fair value based on their discounted cash flow model, based on their free cash flow, and a 48% margin of safety if you bought today. On my bear case, if you bought today, you're getting in at 14. The fair value that I have on this name is 27. 27. Almost a double from today's price. 50% margin of safety would be about $13.70, which we were just there a couple weeks ago. 60% margin of safety is $10, almost $11 here. And then 70% margin of safety is $8.22. What's margin of safety? Margin of safety is exactly what it sounds like. It's your margin between your fair value and your current price. All in here is your margin of safety. So if you want to buy at fair value, buy here, you have 0% margin of safety. 10, 20, 30, 40, 50, 60% margin of safety is that bread and butter where you know, hey, I put in conservative assumptions. Or in this case, I put in my bear case. I put in my bear case for Oscar. If things go wrong and they don't hit the targets that I expect them to and don't get the revenue growth and their free cash flow just becomes crap percentage wise, still a 48% margin of safety from where they currently are right now. That's margin of safety. Margin of risk is just the inverse of that. So 10, 20, 30, 40, 50, 60% overvalued based off of bear case. But when you do margin of safety here, when you do this margin of safety right here, you don't run it off bear case. You either run it off base case, which I don't even do that. I would run it off bull case or ultra bull case. Meaning you put in rosy assumptions here because you don't want to be you don't want to be trimming a company on base case or bear case. You know what I mean? Why would you want to trim off not good, um, like a bear case or bull case or a bear case or base case? You want to be trimming if you throw in bull case scenarios in here and it says, yeah, we're still that overvalued. Okay, then we trim up. 31% annual CAGR, $217 in 10 years' time if they hit the bear case. If they hit the bear case. Nope, actually, that's wrong. Sorry. Hold on. That's 9%. Sorry, I got to update that. 64, almost $65 in 10 years' time. I knew that looked a little weird. Sorry, guys. Not 217. 64, $65 per share, 10 years' time, 16% annual CAGR, which the market on average is going to get you back 8 to 9%, investing in the SP 500 ETF like VOO. And then on EPS coming down here and beating this up too and going very conservative, that's going to get you a 12.4% annual CAGR rate here at $46.17 in 10 years' time. Again, we're currently at $14. You are getting market beating returns over the next 10 years on the bear case scenario for Oscar Health, guys. Can't make this up. So we have negative $1.17 EPS expected this year. Analysts expect them to get to 35 cents or 40 cents next year. I think they can get way higher than that. I think they can get to 60 cents or a dollar if they do really, really well. But let's just go with analysts or a little bit below analysts, 35 cents, and then getting to $1.40 in 2027, which again, that's a little bit lower than what analysts are expecting. And that gets us to a fair value in 2027 of $21.06, 32% margin of safety from today. So that would give you basically a 15% over this 15 or 16% um, annual return over 2026 and 2027 if we got to that number and based on the fair value. In the 2026, based off of 35 cents, would get you, we would be at the fair value is $10.53. Again, that's the fair value. And the reason you don't see this name go under $11 really is again because they have a crap load of cash, and people just see the opportunity and they're priced for bankruptcy. People literally think that they're going to go bankrupt because of the ACA subsidies and everything. Yeah, 30, then a 15 PE, then a 10 PE still gets you 12.4% annual return. So that's my bear case, guys. That's my bear case. If we go in here and we just punch in what they're doing right now, 10% free cash flow margin rate, let's give them a 10 terminal fair value again. Even without changing the revenue here, that already gets us up to $64 per share, a massive 78% current margin of safety. And I'm telling you guys, let's say next year is really bad. Let's say they drop 10%. I think they can go between 15, 20, 25% over the next few years, right? I think they can get there and sustain that. And you're looking at $100 stock. You're looking at an almost 10x on this company. I would call this my bull case. I would call those revenue numbers my bull case with the free cash flow margins just staying the same. That'd be my bull case. My ultra bull case would probably be like, okay, let's grow the free cash flow margin here to 15% over the last 5 years. And I honestly believe that maybe next year is not that bad, -5. And then I think they can grow between 20 and 30% over the next, let's even just throw in a 15 here, over the next 10 years. Now you have $184 stock. You have a 92% margin of safety from today. And in 10 years' time, you'd be looking at a $435 stock. And we're currently at $14. You see how crazy it can get. I believe the floor for this company is $10 or $11 per share. I think it'd be very, very difficult for them for Wall Street without a big crash or bear market. I think, or Oscar just completely messing up on everything. I think it would be very, very difficult for this stock to get under $10 or $11 per share. Because again, they have a lot of cash. They don't have a lot of debt. Yes, they have premiums to pay. They're also pulling in free cash flow. They have a great product. They're integrated with AI. They have all these things that make them an acquisition target, that make them, which I don't think Mark Bertolini sells at all. And you just have a lot of people that believe in the CEO in this company as well. So they're priced almost as if you sold the entire company today, all of its assets and everything, and gave all of that to shareholders, you'd probably be looking at $9 to $11 per share you get in money. So you're buying at the basement level. You're buying at the basement level with very minimal downside. And I just showed you the bear case is $27 per share or $37, whatever it was. The bull case is like $100 per share, and my ultra bull case is almost $200 per share. $14 stock. I don't know what's going to happen in the future. Anything can happen in the future. This investment might not work out. And I understand that. I've been investing for a while now. I understand not every investment works out. But when you get these types of amazing risks versus rewards, you got to take a stab. You got to take a stab. It's even better when you really love the leadership team. So I love Oscar. I think they're going to do phenomenal over the next 2, 5, 10 years. I think I'm going to make a killing on my invested capital in this company. And the only thing now is time. Time will tell. Time will tell if I'm right. Time will tell if I'm wrong. But I know myself. I believe in myself. I know my skills at being able to find these undervalued companies on the basement level and getting in before the masses. I've done it time and time again. I'll prove to you all that I'll do it time and time again. And you are just getting a taste of what I'm able to do. A lot of it will be free. Some of it will be in my community, for my community members, the High Five community, whether it's investing or trading. If you want to join that, link that in the description. But I will continuously win a lot more of these investments, just as I win a lot more trades than I lose, and I'm profitable. Time will tell. Time will tell. But I'm so excited about this company. I think they're going to do phenomenal over the next 2, 5, 10 years. I'm a long-term investor with this name. I have patience with this name. And I'm going to ride this into the sunset, whether I'm right or wrong. It's okay. There will be other investments that I am right on. If this one is one of the ones I'm wrong, or if this one I'm right on and my next one I'm wrong on, it is what it is. That's investing. You're not going to hit every single pitch. Sometimes you're going to strike out. Sometimes you're going to hit a home run. And guess what? It doesn't take many home runs, as you've seen with Palantir, NVIDIA, HIMS, Robinhood, SoFi. It doesn't take many home runs to make a crap load of money. All right, guys. I appreciate you sticking around to the end of the video. Like, subscribe, follow for more. Drop a comment if you're invested in Oscar. How much? What's your cost basis? I want to know. Let me know in the comments below. But until next time, guys, I love you all. Hope you have a fantastic day. I'll catch you in the